The market is currently closed, and as of the final bell on Thursday, June 18, 2026, Nuburu Inc., trading under the ticker symbol BURU on the NYSE American, finished the regular trading session at exactly $0.1645 per share, marking an intraday decline of 2.08% on a massive trading volume exceeding 25 million shares. Right off the bat, here is a development that almost nobody looking at this penny stock is paying attention to. While retail investors are panicking over a 16-cent price tag, recent international regulatory filings indicate that this tiny microcap entity is quietly attempting to reshape its entire corporate profile into a cross-border defense and security asset. The expectations surrounding this equity are incredibly low, with the general market narrative suggesting it is just another struggling microcap bleeding capital until it disappears. Most individuals using popular investing sites or checking their standard individual brokerage accounts see the massive drop from historical highs and assume it is dead weight. However, the reality underneath the surface challenges that simple view, creating a fascinating tension between expectation and facts. When you look closely at their recent corporate actions, including the formal notification filed under the Italian government's regulations regarding a majority acquisition of Tekne, you realize there is a significant gap between what the broader public assumes and what is actually being set up behind the scenes. This creates a compelling scenario for anyone engaged in self-investing or looking for unique, high-risk opportunities across the market. To understand why this gap exists, we have to look closely at recent stock movement and trading activity. Throughout this week, the stock has experienced volatile daily swings, navigating between an intraday low of $0.1511 and a high of $0.1657. The trading volume has been remarkably high for a company with a market capitalization hovering around $29 million. When 25 million shares change hands in a single session, it tells us that liquidity is surging and there is a massive tug-of-war happening between short-term traders and institutional accumulators. On platforms like the Interactive Brokers platform or the Robinhood mobile app, this high volume frequently triggers momentum indicators, drawing in algorithmic traders who do not care about the fundamentals but love the price action. Yet, institutional activity presents a more calculated picture. While massive names like Nvidia stock, Apple stock, or Tesla stock command the focus of institutional giants and dominate index-based products like Fidelity mutual funds or automated options inside Schwab Intelligent Portfolios, microcaps like Nuburu operate in a completely different ecosystem. The institutional accumulation here is not done via massive block trades by Vanguard or BlackRock. Instead, it happens through specialized venture funding, strategic private investments, and debt restructuring agreements. For everyday investors practicing online investing, tracking these movements requires looking past daily price charts and scrutinizing the filings that show how much dilutive capital is entering the framework. This brings us directly to the recent earnings reactions and macroeconomic pressures that have heavily impacted the stock price over the last few quarters. The microcap sector has faced severe headwinds due to sustained high interest rates, which make it incredibly expensive for pre-revenue or low-revenue technology developers to borrow cash. When capital becomes expensive, companies like Nuburu are forced to rely on equity distribution agreements, which dilute existing shareholders and put downward pressure on the stock. This is why we saw the equity fall from its 52-week high of $4.24 down toward its recent historical lows. For retail users utilizing a Fidelity brokerage account or managing assets via SoFi Active Investing, seeing that kind of depreciation can be incredibly discouraging. The expectation was that early commercial contracts would fund operations, but the reality is that the company has had to continually search for new lifelines to sustain its operational expenses. If you look at their recent quarterly reports, the revenue figures remain small, coming in at around $407,000 for the first quarter of the year, while operating expenses topped several million dollars. This structural imbalance is exactly what short sellers exploit, and it explains why the stock remains pinned under the $1 mark, threatening its listing status. Now, let us step back and look at what this company actually does and how its core business model functions. Nuburu was established to design and manufacture high-power, high-brightness blue laser systems. Traditional industrial lasers rely on infrared light, which works well for steel but is highly inefficient when dealing with yellow and red metals like copper, gold, and aluminum. Blue light, by contrast, is absorbed by these metals up to 20 times faster than infrared light. This physical property allows their systems to produce faster, higher-quality welds and component parts for applications in electric vehicle battery manufacturing, consumer electronics, and aerospace manufacturing. The business model is built on selling these specialized laser units, such as the Nuburu AO150 and the newer BL series, directly to industrial manufacturers, while also offering engineering services and developing custom integrations. In past years, the company attempted to scale by penetrating the commercial manufacturing space, hoping that automotive giants would integrate blue lasers into their assembly lines. The early reports from 2023 and 2024 showed immense technical promise, but the commercial adoption curve proved to be much slower than anticipated. Industrial companies are notoriously slow to change their manufacturing infrastructure, especially when facing economic uncertainty, which delayed the high-volume orders that investors were counting on. Faced with this commercial slowdown, the leadership team initiated a strategic shift toward the defense, aerospace, and security markets. They introduced the Laser Arm Initiative, explicitly targeting directed energy applications and the rapidly expanding market for counter-unmanned aircraft systems. This is where the reality begins to diverge from the old expectations. By shifting focus toward military and government contracts, the company is aiming to secure non-dilutive government funding and long-term sovereign contracts that are insulated from traditional consumer economic cycles. Their collaboration through Lyocons and design blue laser technology for underwater power platforms demonstrates how they are trying to apply their core physics asset to unique environments. Comment below how many shares of Nuburu you currently hold, or if you prefer sticking to large caps like Apple stock in your personal portfolio. Hearing your perspective helps gauge how retail sentiment is shifting on these microcap tech plays. Looking forward, the future outlook for this company depends entirely on a few critical catalysts and risks that will decide whether it can break out of penny stock territory. The most immediate catalyst is the pending acquisition review by the Italian government. Because the company has moved to acquire a majority stake in Tekne, an Italian firm specializing in defense electronics, advanced telecommunications, and military vehicle outfitting, they had to file a golden power notification. This means the Italian government is actively reviewing the transaction to ensure it aligns with national security interests. If approved, this acquisition instantly transforms the company from a pure laser component maker into an integrated international defense provider with established European revenue streams. If this deal succeeds, the reality will completely outpace the low expectations currently priced into the stock, potentially forcing a massive short squeeze and attracting significant attention on online investment platforms like SoFi Investing or the Interactive Brokers Trading Desk. Conversely, if the Italian government blocks the transaction, or if the integration costs prove to be too heavy for the company's fragile balance sheet, the operational risk will escalate significantly. The company would be forced to seek alternative funding methods, which could lead to further dilution or restructuring that could penalize current equity holders. Furthermore, we must watch how the broader macro affects retail platforms. When everyday investors allocate their capital into specialized accounts like a Fidelity IRAs or rely on automated advice from a SoFi robo-advisor, they are usually looking for stability. Microcaps like this require active management and a high toleration of risk, which means they are generally found in an individual brokerage account rather than a conservative, intelligent portfolio setup. As trading apps like the Robinhood app continue to make fractional shares and crypto cash management accessible, speculative capital moves faster than ever, meaning a single positive press release regarding a government contract can cause a massive 100% intraday spike, just as a negative filing can erase value overnight. When you look across the wider tech landscape, companies focused on hardware development face a long road compared to software-driven firms. The market has rewarded companies connected to big tech, driving massive volumes into large corporations, while small-cap innovation has been largely starved of attention. Yet for an investor who handles self-investing through independent platforms or looks for investment help to diversify a small portion of their wealth into high-alpha setups, the current valuation presents an interesting asymmetric equation. The expectations assume failure, meaning any sign of operational stabilization or geopolitical contract success could alter the stock trajectory permanently. To bring everything together, the central insights surrounding Nuburu show a distinct clash between past narratives and current structural pivots. The old expectation was that the company would easily dominate the commercial electric vehicle battery welding market, a thesis that fell apart due to slow corporate adoption and high capital costs. The new reality is a high-risk transition into directed energy defense applications and European defense infrastructure acquisitions. While users checking their Fidelity mobile app or tracking prices via the Robinhood trading platform might see a stock that looks beaten down, the underlying corporate moves indicate a management team trying to survive by shifting into a highly protected, government-funded industry. It remains a classic case of expectation versus reality, where the risks are undeniably high, but the potential rewards are tied to geopolitical security needs rather than standard commercial retail trends. Managing an asset like this requires looking past standard investing sites and keeping a close watch on international regulatory decisions, government defense appropriations, and the company's quarterly cash burn rate. Whether this strategic pivot will successfully lift the company out of the sub-$1 zone or leave it as a cautionary tale of slow corporate adoption remains the critical question for anyone watching this unique sector. Disclaimer. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Buys. Don't forget to like, comment, and share this video to support the channel.